Well, it's time now to get in some global opinion on the markets. Stephen Eglander, Managing Director, Global Head of G10 FX Research, North American Macro Strategy at Standard Chart, and Matt Orton, Chief Market Strategist, Raymond James Investment, are now joining us on the show. Gentlemen, thank you very much for joining us this early India time. I'm sure it's very, very late for you. Stephen, let me start with you and get your thoughts on the possibility of a U.S. recession. Donald Trump says the U.S. economy is going through a period of transition. Treasury Secretary Scott Bessent says there could be a period of detox for the U.S. economy. Are the fears of a U.S. recession overblown, or is it a legit concern?
Well, I think President Trump sees early 2025 weakness as a freebie, in the sense that if he raises the alarm and it happens, he can blame the previous administration. If it doesn't happen, he can take the credit for himself. Market sentiment has deteriorated a lot, but I think well beyond the deterioration in the data. The big increase in the trade deficit that mechanically pulls down GDP is very misleading for a number of technical reasons and shouldn't be paid attention to. And I'd say that with energy prices coming down, and the weather improving, we're probably going to see more room for consumer spending in March and beyond. So we do think the economy is slowing, but nowhere near the pessimism that's being expressed.
Okay, well, right now it seems to be, maybe then it's a knee-jerk reaction in the market. Stephen got that. Let me ask Matt that question as well. Matt, great to have you on the program. So, I want to ask you what we were sort of theorizing over here just a while back, whether the events of the last week and a half, last 2 weeks, which have been really quite brutal for U.S. equities, whether they will lead market participants to finally look out of the U.S. Is this whole U.S. exceptionalism coming under a bit of a cloud till this tariff issue finally settles and resolves and we finally know the numeric impact?
Good morning, Surabhi. It's always great to join you. And I think that's exactly what's unfolding. While I'm not in the recession camp for U.S. equities, I fully agree that growth is going to slow down. But I think what U.S. investors are being reminded of, and kind of a key theme of mine heading into this year, is that diversification is really, really important. And you can diversify your portfolio not only within U.S. equities across industries and sectors, but you can also do that through asset classes and also through geographies. And so we just saw one of the strongest 4-week inflows to European equities that we've had over the past 10 years. So the flows that we're seeing into Europe and out of the US are very, very real. And I think a lower dollar, just like we talked about a few weeks ago, that is the critical piece to spurring emerging market equities, and I think having some sustainability behind that. So I do think that U.S. investors are looking elsewhere. I'm traveling this week, meeting with clients, and that is a sentiment I'm getting, is really interested clients asking, where else can we look in this market where we're not going to be leaning into momentum, which is what's not working, and where can we find some growth that might not be at risk of a growth scare like we're seeing in the U.S. And I think India does fit that bill. It might take some time, but I think there's definitely interest.
All right, that'll be good news, Matt. And you've been quite positive on the Indian markets as well. Let's come across to you, Stephen, though. Tell us how you're reading the global central bank action. In the last couple of weeks, we've got some weakest data coming out of the United States. It could be temporary in nature. But suddenly, the Fed futures, they are factoring in a couple of rate cuts from the Fed. Do you think that's going to happen this year? And also tell us about the Japanese central bank, because the other fear was there's a possibility that they go in there and hike interest rates. But suddenly the data out there is not up to speed as well. So what are you expecting from both these two big central banks?
Well, Japan to do more and the Fed to do less. The Fed doesn't have that much time to cut rates because there will be a fiscal bill. It's likely technically it will be paid for, but I think there'll be a lot of doubts that it's going to be deficit neutral. I think by the time we get into the second half of the year, and certainly as we get well into the second half of the year, the Fed will be very hesitant to cut rates. So, we've had 2 cuts for a while. We think that that's pretty reasonable. The market now has 3.5. I think that's a bit exaggerated. In Japan, yeah, the GDP number was revised down a bit. I think it's one number. Overall, the Japanese economy isn't doing badly. And the wage side and the inflation side is doing well. So we still expect 2 hikes from the BOJ and basically, the yen to continue to outperform other currencies in coming months.
So the BOJ hikes twice this year, and the Fed cuts twice as well. 50 bips is what we should work at, 25 to 50, or that as well may not come about.
Right, correct. We think that the Fed will cut in Q2 and it'll cut in Q3, but after that, it's going to be very hard for them to cut, given the fiscal tailwinds that the U.S. economy is going to have. Whereas Japanese real interest rates are still very low. And, every central bank thinks it can control inflation. But once inflation sort of gets out of the corral, it's really hard to bring back down. So we think that they'll end up doing more rather than less.
Stephen, then how is it, or what is it that makes you not too concerned about overall U.S. growth? I understand you're not in the recession camp. But if we put all of this together, the impact, first of all, tell us, what do your models say? What could be the total impact of these tariffs? Some people argue it could be as much as 1% of GDP. There's obviously inflation that's becoming an issue. Do you see stagflation becoming a problem for the U.S.? What really lies ahead in the next, say, 1 or 2 quarters for the U.S. economy?
There is a risk of price hikes accompanying tariffs. I mean, it makes no sense to argue that it's not going to happen. Historically, that's been the case, and it's unlikely that currency moves will absorb all of the tariff increases. I think that they're pulling back, say, on the tariffs on Mexico, the tariffs on Canada, reflects the fact that they're coming to realize that tariffing trading partners, especially essential trading partners, is more complicated than it looks. So I suspect that the net overall will be, single digits in tariffs, probably not double digits overall. Some noticeable effect on inflation, but not, not something that's a game changer. I do think that they're determined to use fiscal to get taxes and to re-stimulate the economy. And that part, I think, is going to be dollar positive towards the end of the year, and it's going to push rates back up again. I think the market is playing with fire a little bit and taking yields as low as they're doing right now.
So you expect, you said dollar positive. We've seen the dollar index, Stephen, come down from levels of more than 110, now down to sub 104. Reciprocal tariffs come into effect from early April. What's the call on the dollar index and the U.S. 10-year yield?
Well, look, the dollar might weaken in the short term for all the reasons we've been discussing. We expected the U.S. economy to slow down in the first half, and it's slowing down. The Fed is likely, they can cut a bit and then raise rates if they have to. So I think that we're in a dollar correction. We're not in, switching to a 5-year dollar downtrend. I think that when we get the stimulus in the second half of the year, rate differentials will reassert themselves and the dollar will be stronger again. So, enjoy the dollar weakness while you can.
Oh, okay. Enjoy the dollar weakness while you can. That's interesting. So yields in the dollar are heading higher. That's what Stephen's view is. Matt, just very quickly, equities. You've always been a fan of Indian equities. Now, against this new backdrop, what would your advice be to investors on India?
So my advice to investors in India is the same as it is globally. Right now, you need to lean into quality companies. You need to identify companies where you're seeing earnings continue to move higher. I think those companies do exist. Some of the names we've discussed before, like Bharti Airtel, which has been a holding that I like, that has held up very, very well. And I do think there's going to be buying opportunities in financials in particular. I think what Indian equities have to look forward to is the fact that they've already gone through the growth scare. That's really what we're seeing unfold in the U.S. right now. And with that in the rearview mirror, is investors investor sentiment starts to improve, and if the dollar does remain weaker, I think that's going to help move flows back into the market because there's already been a valuation adjustment, there's been a growth adjustment, earnings forecasts have reset. So I do think there's an opportunity. I want confirmation, though. I'm not adding any new money until I start to see the technicals improve because I'd rather be a little bit late than too early and still have a little bit of the bottom fall out.
Okay, and Matt, just taking a final sort of chance on this, I'm not sure, since you do look at some of the large cap Indian stocks and banks particularly, I don't know if you caught the headlines that are coming out this morning, actually last evening India time, on IndusInd Bank. They have some accounting issues with some of their derivative positions, trading portfolio, and that could cost the bank a couple hundred here and there. I don't know if you saw the news. Any thoughts on IndusInd, if at all you've had a look at it?
So no, Surabhi, I haven't had a chance to look at the specifics there. But again, I think it just highlights the reason why you need to lean into quality and also know the companies you own. Obviously, there's some situations you can't forecast going forward. But in this market, I would sell and trade for banks like ICICI or HDFC, ones that you know have incredibly solid management teams where you're not going to run into these issues.
Okay. All right, gentlemen. Thank you very much. Appreciate you both being with us on the show this morning and giving us perspective both on the US and as well as how to look at the Indian market in this context. Thank you for joining in.